Good evening, everybody. I'm Mayuri Joshi. I manage funds on behalf of Angel Broking Limited, and the whole discussion agenda today is the expectations from the Union Budget, which is over the next 2 days, and the implications that it can have on certain sectors and stocks related to those sectors. Having said that, with the economic survey which came in yesterday, I think it was a conservative estimate that the economic survey has put through in terms of GDP projections for the coming fiscal, pegging it between 7.5%. But to a large element, I think the two large disruptive events, demonetizations in the year gone by, the implementation of GST, did cause disruptions in terms of the flow of the markets in general, not the equity markets, but the markets in terms of the organized and the unorganized sectors, the reporting norms, and the collection figures that we've probably seen in terms of GST collections with a lot of slabs getting moderated. You've probably seen the tough part happening on the GST part. So as collections start improving, as compliances become a lot more easier, the indirect tax collections over the next few years is definitely going to improve. How does it affect the budget arithmetic for the fiscal year ahead as well? So the direct tax collections have been pretty healthy. So the reported numbers in the revised estimates that will come through that were discussed for this budgetary year, the direct tax component is going to be significantly better. Obviously, because of the disruptions that we've seen, the indirect tax collections will be having a marginal shortfall. But again, the offsetting effect in terms of larger divestments coming through specifically will probably have some amount of a soothing effect. Again, I think in terms of expectations of revenue growth, because on a twin balance sheet perspective, you're probably looking at the revenue aspect and the expenditure aspect. On the revenue aspect, again, a 9 to 10% growth net to the center is something that the street is probably envisaging at this point of time. And a greater share of that will probably come through in terms of direct tax collections. In terms of what can actually get expended, again, the focal points, as I see for the budget, is going to be four A's. So I think the first A is probably going to be agriculture and rural, because that is one of the most critical themes in terms of the expenditure aspects of the government, and they probably need to focus on that specifically after the Gujarat mandate, and the rural focus will be clearly reflected and vindicated through larger allocations happening in this subsegment of and strata of the society. Again, I think the Prime Minister's vision and the budgetary documents that have been supportive, specifically the economic survey, are indicating with the fact of doubling of farm income by 2022. I think so. Definite and concrete steps will be taken in this direction. So again, I think the first A, agriculture and rural, is going to be an extremely critical and exclusive theme for the government in this budget. The second theme related to A is going to be allocation towards infrastructure. Again, I think it's a known fact, and the Roads and Highway Minister, Nitin Gadkari, has made it clear time and again that larger allocation and capital outlay is probably required, not just towards roads, but power, railways. You're probably looking at ports, in waterways. So again, the budgetary allocation for the year gone by of 2,41,000 crores. Our estimates are that a significant allocation can actually happen over and above this, what was discussed last year. What this precisely and concisely means is that a lot of stocks within sectors related to the EPC theme of roads, the EPC players within the power side of the business, the inland waterways, railways, larger allocation happening on that front again, I think are going to benefit selectively stocks within these sectors. So I think this is the second A that I'll be focusing on, where the budget impetus will be. The third A will be obviously affordable housing. Now again, the Prime Minister and a lot of supportive documents related to the budget, including the economic survey, have made it very, very clear that this element needs to probably improve. What you've probably seen in terms of the core construction activity under the Pradhan Mantri Awas Yojana scheme is that it is actually not in terms of the anticipated numbers that one really looks at from a statistical point of view of the construction that should have happened for the newly constructed houses under this particular scheme. But the government will be very, very focused on implementing this, and larger allocation can probably happen on the Awas Yojana as well. And again, I think strict implementation on that front. Now, whatever probably happens in terms of expected changes from GST when it comes to the affordable housing space, either incentivizing the sector even more and larger allocation, as I've been mentioning, I think is going to create a lot of impetus for a lot of developers who are probably either present in this space or wish to get into this space because of the obvious inherent benefits that they can derive out of this. Generally, for the real estate sector, what probably comes through in terms of GST rates, specifically for under construction projects, which is around 12% right now, which is again a net off of what you've probably seen at 18% less the land cost and the input tax credit that is available for builders and developers. I think any tweaking on that front is probably going to create a lot of interest within this sector as well. So a lot of players within the affordable housing space, the developers within this space, probably can be in a sweet spot because of the government impetus. Now, what happens in terms of the end user? Again, I think the tax exemption given in terms of the interest on loans taken for housing properties and the principal repayments. If there is some amount of higher threshold on these limits that have been envisaged, we are probably going to see a lot of kickoff happening in terms of either resale of properties which have not got sold at the builder or developer end, or again, I think new launches which are probably happening either on the affordable space or otherwise, probably picking up steam significantly. Again, I think in terms of job creation, what the economic survey was pointing out was that significant accretion can be done through a lot of sectors, which also include real estate and obviously textiles. So again, a lot of impetus more be given in terms of incentivizing these sectors overall, so that larger job creation can probably take shape, and that probably also tackles the kind of dilemma that the government is probably facing in terms of job creation. So a large element of the third A is affordable housing. And again, I think different sub-segments, because once you're talking about housing and a lot of construction activity related to that, you're probably looking at cement as a space that can do well, because that's one integral part for housing. Again, a lot of the players within the industrials and a lot of stocks within industrials can actually do well. The home improvement theme is an offshoot if greater allocations probably start happening towards the first stage, that is agriculture and rural side. And that can also be a big game changer for a lot of these home improvement companies, which can obviously include paints, they can obviously include a lot of ceramic players, you probably got a lot of refractory players that can benefit from this. So selectively, these themes within the third A can do really well. The fourth A obviously is going to be any kind of allocations towards increased tax exemptions and limits on that part. So apart from the interest and pensions that I was talking about on allocation, increase in the threshold limits for interest on housing payments in principle, if there is some amount of leeway given in terms of the base tax rate and some moderation done, even on the corporate tax front, I think a lot of spurt can actually happen on the discretionary spending part. And as the demand is expected to remain buoyant over the next few quarters and years for a growing economy like India, my own sense is that the kind of multi-benefits that one can actually look at from these tax cuts can actually start getting played out very, very meaningfully, both in terms of our gross domestic product or the GDP, probably improving quite drastically over the next few years, and we probably remaining on top in terms of the fastest growing emerging markets in the country, in the world. So in that sense, again, I think the risks that the exchequer or the finance minister faces at this point of time, which were clearly highlighted even by the economic survey that was released yesterday. And the outside joker in the pack is obviously going to be crude. Now, crude is hovering around that $69, $70 kind of a mark. But if that sustained up move continues, it does put pressure in terms of how the government positions itself. Because the kind of benefits that the exchequer had derived with lower crude and the kind of savings that we've done because of lower crude was significant, not just from a current account and fiscal deficit side, but it also had a soothing effect in terms of the inflation. Again, I think if crude moves up, it does create some amount of impact. A $10 move in crude does impact your CPI anywhere between zero point 0.3 to zero point 0.4 percentage points, and does that have an upward pressure? And though the CSO, the survey has pointed out of the inflation on the CPI front remaining below 4%, I think this is one factor to watch out for. The second element obviously becomes in terms of the price staying above 70-75 and the elevated stress that it brings in terms of the additional spending that the government probably needs to do in terms of subsidies as well as spending on crude because of elevated prices. So to that bit, I think that elevated pressure on the fisc might play out. And that again brings us to the point where the finance minister will be able to walk the talk in terms of fiscal consolidation. He's been able to do that very, very successfully over the past 3 years. And again, I think the jitteriness that the bond markets exhibited a few weeks back when the government announced the additional 50,000 crore borrowing program reverted back to 21,000 crores, and whether there will be a fiscal slippage. Again, I think a minor slippage, even if it comes through, I think can very well get accepted by the markets. I think the bond yields are already a testimony in terms of anticipation of that happening. But the knee-jerk reaction not probably ruled out. Whether he sticks to the target that he had put forth in the last budget in terms of what he's predicted to do in the coming fiscal, I think a normal slippage there also can be expected and accepted by the markets. And the gestation fact is understood from the yield factor itself. So I think the yields are a testimony in terms of how the expectations from this outside risk when it comes to the fiscal prudence roadmap is planned out. But I think the equity market should take them in their stride. In terms of projections for the GST collections on the indirect front, I think it's going to be very, very difficult. But as I said, I think we're probably hitting the trough in terms of collections. And the last figure probably is a testimony that as compliance become a lot more easier, as the tax labs have come in a moderated fashion, there might be some moderation happening on a few tax labs as well. I think you probably are expected to see significant improvement happening on that front. On the capital expenditure side, again, as I said, I think larger allocation happening towards capital outlay infrastructure in particular. The defense outlay can also be quite significant in this budget. The revenue expenditure obviously is going to be significant in this year's budget as well. And the subsidy element, again, I think the kind of movement in crude, we're probably accounting for almost 25,000 crores in terms of the subsidy allocation. That might have an upward figure if crude moves up and stays at elevated levels. But a large element in terms of providing for subsidy should get contained around that 1.5 or 1.6% mark of GDP. So having said that, I think a few sectors where positive movement can happen obviously is going to be around these 4 A's as I discussed. So I think agriculture and rural, where the allocation can be quite reasonably better compared to last year, will impact a lot of sectors, fertilizer players. You've probably got a lot of these pump players, you've got a lot of these microfinance companies, rural focused finance companies, tractor makers are doing well. Larger allocation towards defense, obviously a few defense players where order books are already quite healthy. They're able to increase their order books, their revenue visibility goes up. And as they're able to churn and sweat their assets better, the leverage on their balance sheet will obviously reflect greater ROEs over the next few quarters and years. Again, affordable housing, and within that, I think a few of the real estate developers on the affordable housing side can really do well because the government focus here is going to be very, very pertinent and very focused at this point of time. So a few players will benefit out of this. I think as exemption thresholds increase, a few of the housing finance companies who specifically cater to these low ticket sizes can actually do well. That will obviously have a huge amount of leverage onto their balance sheets. Within the auto universe, again, I think the scrappage policy, if any announcements not done on that front of vehicles with a vintage life of more than 10, 15 years and any incentives for scrapping these vehicles. Obviously, a few of the MHC players benefit in a significant manner. But a few of the two-wheelers players who are probably focused towards the rural and semi-urban areas can have larger volume growth as more discretionary spending starts coming through. FMCG and consumer staples as a space can really do well over the next few years because as a country, I think as we move up the value chain, a lot of these players who are trying to increase their distribution network, cut through the wholesale supply chain, open up their own distribution network and outlets, and carry their retail reach forward, is going to benefit them significantly. A lot of these balance sheets are actually very, very healthy. And it's unlike the capital goods or industrials, where a lot of leverage is not taken on their balance sheet. But a large element of demand coming back, of creating that impetus that the government so desperately needs in providing for volume growth for these companies, can actually start coming through. And as I said, as India moves towards the 5 trillion economy mark over the next few years, I think a lot of Indians from semi-urban rural areas going into the value chain will have a huge say in terms of the volume growth for a lot of these FMCG, white goods, and consumer staple plays. So selectively, these sectors should also do very, very well. In terms of the private capex not picking up, a large element in terms of the private capex stuttering at this point of time is actually gestated by the market. But you've actually seen some green shoots coming through. So few steel companies actually announcing expansion plans does augur well. And again, I think you're probably looking at that percentages of 100 GDP actually starting to move up. So my own sense is that it's going to be a practical and a pragmatic budget. Yes, there will be some stops announced because a lot of elections are around the corner, specifically on the state side, and the government probably needs to create their mark specifically on the rural side and show that they are here and what they say in terms of creating a lot of value for common Indians spaced out of rural and semi-urban India, and the government is working towards them. The bank recapitalization, obviously, in the announcements done, I think it's done outside the budget. So the cleaning up of balance sheet, you've probably seen a lot of provisioning actually happen, and a lot of credit outlay actually happening towards the needier sections of society. I think this is also something that needs to be closely monitored and watched out for the budget. So again, I think the bias is with the private sector banks, the larger ones, because I think the stressed out issues both in terms of asset quality as well as credit growth probably not as starkly different compared to the PSU banks. But largely, again, I think the retail advances for the private guys have been far better. The recognition, at least on the retail-oriented private banks in terms of asset quality, has been far, far superior, and that has been reflected in the return ratios. So again, I think hoping for a very pragmatic budget to come through, and again, the hope here from a market perspective is that nothing is getting tinkered on the LTCG front, because that is the biggest fear for the market at this point of time. So with that, I think this is my summary of what is expected from budget. I'll be happy to take any questions if anybody has.